Did you know that a BC billionaire's plan to take over former Hudson's Bay stores is causing quite a stir in the commercial real estate world? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In recent filings with the Ontario Superior Court, major landlords like Cadillac Fairview have expressed their strong opposition to Ruby Liu's ambitious plan to acquire 25 former Hudson's Bay leases. According to CBC News, these landlords claim that Liu's strategy defies commercial common sense and lacks a detailed, credible business plan. Despite Liu's ownership of 3 shopping centers in British Columbia, the landlords argue she does not have the necessary experience or staff to manage these large retail spaces effectively. Cadillac Fairview, along with Oxford Properties and other prominent real estate companies, have asked the court to prevent Liu from becoming a tenant. They are concerned that Liu's business, as described in her filings, appears to be an empty shell with no guaranteed financial backing beyond her own assurances. This sentiment was echoed by Rory McLeod, Cadillac Fairview's executive vice president of operations, who stated that Liu's company might run out of funds before even opening its first store. The Hudson's Bay leases in question cover some of the most coveted retail spaces in Canada. These leases, originally secured by the Bay at favorable terms, have become a focal point of contention after the retailer filed for creditor protection earlier this year. The Bay has sought court intervention to compel property owners to accept Liu as a tenant, with a hearing scheduled for the end of the month. Ruby Liu envisions transforming these spaces into multifunctional department stores, featuring retail, dining, entertainment, and even educational centers. However, Cadillac Fairview and other landlords argue that such plans exceed the scope of what the current leases allow, which is strictly for department store operations. This discrepancy has fueled skepticism about Liu's ability to adhere to lease terms while implementing her broader vision. Additionally, landlords have raised concerns about Liu's proposed timelines and budgets for renovations and inventory acquisition. They argue that her plan to open 20 stores within 180 days and her budget for necessary repairs are unrealistic. For instance, McLeod estimates that over $15.8 million in repairs are needed by the end of 2026, far exceeding Liu's stated budget. Staffing is another critical issue, as Liu's plan requires 1,800 employees, which some executives believe is insufficient to manage a nationwide chain. McLeod has expressed doubts about the viability of Liu's staffing estimates, stating they are inadequate for the scale of operations she envisions. The outcome of this legal battle will have significant implications for the commercial real estate landscape, particularly in how retail spaces are repurposed and managed. As this story unfolds, it serves as a stark reminder of the challenges and complexities involved in large-scale commercial real estate ventures. In a strategic move to expand its industrial real estate portfolio, S2 Capital has announced the acquisition of Fort Capital, a Texas-based owner and operator of industrial properties. This acquisition marks a significant expansion for S2 Capital, a national vertically integrated real estate investment manager. With this deal, S2 Capital will incorporate a new wholly owned industrial vertical that includes 11 million square feet of industrial space, managed by a robust 50-person investment team. S2 has appointed Chris Roach as president and Parker McCormick as chief investment officer of the newly formed industrial platform. They will join S2's founder and chief executive officer, Scott Everett, in leading this expansion. The strategic focus of this platform will be on acquiring and managing value-add and core-plus industrial assets, particularly in high-growth markets across the United States. The emphasis will be on shallow bay infill industrial properties, which are essential in today's logistics-driven economy. Fort Capital, founded in 2010 and based in Fort Worth, Texas, brings a wealth of experience and a portfolio of over 11 million square feet of industrial assets to S2 Capital. Their investment strategy is deeply informed by market knowledge and established relationships, making them a valuable addition to S2's operations. The combined platform will manage an impressive 11 million square feet and maintain an active pipeline targeting approximately $350 million in new acquisitions. With the integration of Fort Capital's assets and expertise, S2 Capital aims to leverage its capital markets infrastructure to pursue institutional quality opportunities in logistics markets that are currently undersupplied. This acquisition is expected to close on August 11, 2025, subject to customary closing conditions. The move aligns with S2's vision of building an industrial platform that matches its renowned scale and operational excellence in the residential sector. Scott Everett, S2's founder and chief executive officer, expressed enthusiasm about the acquisition, highlighting the complementary nature of Fort Capital's team and portfolio. He noted that the acquisition allows S2 to offer a new strategy to investors seeking enhanced portfolio returns in a high-growth sector characterized by needs-based resiliency. The ongoing growth of e-commerce and rising transportation costs underscore the importance of proximity to consumers, a strategy that aligns with S2's residential approach of following rooftops across the country. Chris Powers, founder of Fort Companies, shared his excitement about the partnership with S2, emphasizing the alignment of entrepreneurial, strategic, and forward-thinking values between the two entities. This partnership is seen as a powerful step forward in enhancing what both platforms can achieve together. Boston's industrial real estate market has shown signs of cooling down in the second quarter of 2025. The Boston Real Estate Times reports that leasing activity has slowed, vacancies have risen, and asking rents have declined. According to Savills research, these trends indicate a market increasingly shifting in favor of tenants amid economic uncertainty and rising supply. Net absorption remains negative, totaling negative 200,000 square feet year to date, with activity primarily focused on lease renewals rather than new tenant move-ins. The vacancy rate in Boston's industrial market rose to 8.1%, a 140 basis point increase year over year. This rise is attributed to macroeconomic headwinds and an oversupply of new space. As competition among landlords intensifies, average asking rents fell 2.9% quarter over quarter, landing at $13.28 per square foot, triple net. This decline underscores a tenant-favorable environment, marking a shift from the aggressive rent growth of previous years. The Boston region's total industrial inventory reached 334.9 million square feet, increasing from 323.2 million square feet in the second quarter of 2024. However, new deliveries have slowed, with only 0.8 million square feet completed so far in 2025, significantly less than the 7 million square feet delivered by this time last year. Construction pipelines have also tightened, with 3 million square feet under construction, down from 6.9 million square feet in the second quarter of 2024. Developers are responding to softening demand and elevated vacancies. Despite the slowdown, several sizable leases were recorded during the quarter, with a noticeable tilt toward renewals. For example, Destination XL renewed a 674,000 square foot lease on Route 128 South, and New England Sheets renewed a 162,000 square foot lease on Route 495 North. These renewals highlight how many tenants are opting to remain in their current spaces rather than take on new space commitments in the current environment. With vacancies rising, absorption in the red, and rents softening, the remainder of 2025 is expected to continue favoring occupiers. Tenants entering the market are likely to encounter more flexible lease terms and more space options, while landlords may need to adjust expectations and pricing strategies in response to shifting demand. In celebration of its 15th anniversary, Northeast Private Client Group, a prominent investment sales firm specializing in commercial real estate throughout the Northeast, has marked a significant milestone. According to the Boston Real Estate Times, since its founding in 2010, the firm has closed more than 1,350 transactions, totaling over $4.1 billion in sales volume. Robert Paterno, the vice president of brokerage at NPCG, attributes this success to a vision driven by a dedicated team and the trust of clients across the region. Northeast Private Client Group is headquartered in Shelton, Connecticut, with offices spread across the Northeast. The firm provides strategic advisory and investment sales services across various property types, including multifamily, retail, office, and industrial assets. Their approach combines national reach with hyperlocal knowledge, allowing clients to navigate changing markets effectively and unlock value in their portfolios. As NPCG looks ahead, The firm remains committed to expanding its platform, investing in top-performing talent, and continuing to deliver tailored solutions for its clients. This milestone underscores NPCG's reputation as a trusted advisor, with a focus on relationship-driven advisory and deep local market expertise. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.